Will inflation ever come down? Are we stuck with higher mortgage rates forever? In the previous masterclass, I gave you an overview of inflation and how it affects mortgage interest rates, the Fed's strategy to tame inflation, and overall housing. If you have not gotten a chance to check it out, click on the Rates, Recession, and Real Estate Masterclass link. That said, I thought it would be essential to dive in deeper into the topic of inflation, update you on the current inflation rate, explain why the readings are so high, and most importantly, forecast where inflation readings should be later this year and next year, and how that will affect mortgage interest rates. A very special thanks to Barry Habib at MBS Highway, the Mortgage Bankers Association, and Fannie Mae for gathering this data. Let's dive right in. As a reminder, inflation is the rate of increase in prices over a given period of time. In other words, inflation is too many dollars chasing too few goods. Now, as you know, the Fed has been increasing the Fed funds rate to try to tame inflation. The latest hike happened on September 21st, and we will likely have another hike in early November. The question is why the Fed is doing this and what that could mean for mortgage interest rates. Well, let's start with the term called demand destruction. What the Fed wants to do by increasing the Fed funds rate is called demand destruction, meaning they want these dollars out of circulation. Like anything else, if there are more buyers bidding for goods, the prices go up. So the Fed wants to take away some of those buyers and destroy demand because of fewer goods. Now, how do you do that, and how does that work? Well, in the Rates, Recession, and Real Estate Masterclass, we explain in detail that the Fed does not control mortgage interest rates, but the Fed controls the price of money. In other words, the Fed has an overnight lending rate that is good for one day, and it usually is the cheapest money out there, called the Fed funds rate. Now, even though the Fed funds rate does not directly influence mortgage rates, things like credit cards, car loans, home equity lines of credit, and some of the big ones like commercial and industrial loans are influenced by this rate. Now, why would the Fed want to destroy demand? Well, a few reasons. First, we've had fewer goods because of COVID lockdowns. We've had fewer goods because of shipping and supply chain issues. Overall, the goods flow have been slow until recently. Secondly, we've had more money in circulation and a low savings rate. Not only was the Fed injecting the market with liquidity by buying mortgage bonds and treasuries, but the saving rates have also suffered because it was cheaper to borrow money in previous years. When rates are higher, the opposite is true, which is what the Fed is trying to do by increasing the Fed funds rate. They are increasing the Fed funds rate and are trying to pull money out of the economy. The Fed is trying to make saving more of an incentive. By raising the Fed funds rate, they're trying to slow down spending, incentivizing you to tuck away the money and save, resulting in fewer dollars in the overall system, thus slowing down demand and allowing supply to catch up. Let me give you an example. Let's pretend our relative was car shopping and was looking at a $30,000 vehicle, but they were limited only to being able to purchase what they had in cash or savings. They likely wouldn't buy the $30,000 car, yet they do because of credit and lower rates, right? The vehicle seller or the dealership receives the $30,000 because our relative borrowed money on credit. But where did that money actually come from? Well, it was created via a keystroke and $30,000 showed up. That's inflationary because we know that liquidity is typically derived from credit. Get this, for every $17 in our economy, 16 of those dollars are actually generated by credit. You see, when the Fed funds rate, which directly affects car loans, is lower, the consumer may go out and buy the car and $30,000 is created. However, if you increase the Fed funds rate and make the payment higher, the borrower will think twice about possibly keeping the car they have a little longer. Therefore, you don't have the infusion of money created by a keystroke in the overall economy. Now, how does this example of inflation apply to mortgage interest rates? Well, as previously explained, as inflation goes up, mortgage rates go up. As inflation comes down, mortgage rates come down. This pattern repeats itself until the Fed fixes the game, right? As previously mentioned, when the Fed was buying mortgage bonds to extend the fixed price of mortgage rates to around 3%, even though inflation was going up, mortgage rates actually didn't move. Why? Because at that period, the Feds were buying enough mortgage-backed securities to keep mortgage rates down, making it cheaper to borrow money. Looking back, the Fed should have exited their buying program sooner and started hiking the Fed funds rate earlier before inflation started to skyrocket. Instead, they started to tame inflation here because, as they said, this rise in inflation was, quote, transitory, but they were so wrong. Nevertheless, if we look at the correlation, this graph gives us a great indicator of what we should expect moving forward. Inflation goes up, mortgage rates goes up. Inflation dips down, mortgage rates dip down. So the question is, when? When is inflation going to come down? Well, we already know that there are forces out there that will cause inflation to drive down in a lower direction, i.e., less money for fewer goods and a higher Fed funds rate, right? That said, the answer lies in the core consumer price index. Now, what is it and how does it work? The core consumer price index, aka core CPI, is an excellent measure of inflation. The core CPI is the change in the cost of goods and services, but it does not include those from the food and energy sectors. Food and energy prices are exempt from this calculation because their prices can be too volatile or fluctuate wildly. Food and energy are staples, meaning demand for them doesn't change much even as prices rise. For example, gas prices may rise with prices of oil, but you will still need to fill up the tank to drive your car. Similarly, you won't be putting off buying groceries just because prices are rising at the store. So in short, the Fed's monetary policy can't control food and energy. That is why we strip it to get a reading on inflation. In contrast, the Fed can influence the core rate, which at the time of this recording on a year-over-year basis is about 6.3%, way over the Fed's target of 2%. Now, how do we calculate this rate? Well, you take individual month readings, add them up, account for a little bit of rounding and compounding, and get to about 6.3%. Now, because core CPI is a year-over-year calculation and mortgage interest rates have a lagging effect on inflation readings, we have seen mortgage rates go up substantially, especially in the third quarter of this year, as you can see by the graph. Now, let me just dig a little deeper here and explain. Let's take August core CPI reading, for example. In early September, we got the inflation readings for August 2022. When we got this reading, it replaced August 2021's numbers. Now, notice how low the reading was for August 2021, 0.2%. You take 0.2 and replace it with 0.6, and the year-over-year reading goes from 5.9% to 6.3%. The bond market didn't like it, and that's when mortgage rate environment went haywire. That said, we have one more month to get to, and at this time of this recording, this reading comes out this Thursday, October 13th, 2022, and that reading of core CPI is for September of 2022 that will replace the reading for September 2021. Now, we're not sure what the reading of September 2022 will come in at. It could come in lower, and the bond market will like it. But just like August of 2021, September 2021's readings was such a low reading, 0.3%, that we could see a push higher in the inflation reading for September 2022. If that happens, interest rates could go through a tough time in October. Now, here's the good news. We believe rates have better days ahead, and it should begin when we see the October 2022 core CPI reading, which we will get that particular reading in early November. We are optimistic about the future of mortgage rates because if we look at the core CPI readings we saw in late 2021 and early 2022, they were all pretty high. This means that if we get a more normalized reading of inflation, especially with the recession happening, the hike in the Fed funds rate, more savings, slower businesses, you're going to see a monthly inflation reading that could be lower, and that will cause the year-over-year reading of inflation to come down. Now, mortgage rates will follow suit, and as predicted by institutions like Fannie Mae, the MBA, rates should dip below 5% going into Q1 of next year for that reason. Now, all in all, we believe that investing in real estate is important, but you do that when you're ready. And we hope that this information gives you the necessary data you need to make a good financial decision for yourself. Thank you for tuning in. See you next time.